So one of the first lessons we're going to go over is what is a game plan, obviously the title of the book. And as we mentioned in prior videos, a game plan comprised of three key components. It's going to be your entry price. From there, you want to determine your stop price or your exit. And lastly, it's going to be your target price. Those are the three simple and key things you need to put together before putting any orders into your brokerage account. And as we go through this book, we'll go over why we focus on percentages, why we try to look to risk 1 to 5% in our swing trading ideas with the goal to make 5 to 25%. These will touch on points where we focus on the percentages, where we focus on proper risk reward. And this all revolves around the game plan. It all starts there. That's what is required before you put a trade on. For most individuals, they do this backwards. They hear about a stock or an investment from a friend or a peer. They invest in it, and then they try to form the game plan after the fact. And then they start to make emotional decisions based off what the investment is doing. When you can do that beforehand, before any money has left your brokerage account in exchange for the investment, you've made that plan of what you're going to do, you will remove some of the emotional aspect of the investing side of it. Not all of it, of course, but most of it, because you're going in with a plan. You're not forming the plan when the game is already being started to play. So the first thing we want to go over this lesson is to buy or not to buy. Again, this lesson goes over an example where our main focus is to focus on the more expensive names when the newer trader typically gravitates towards the cheaper ones. And the reason for that is quite simple, is that when you're starting out, you think certain things are important when they aren't as important. And one of the major things is if the assumption or the incorrect assumption is that with the more shares of a name that you have, you can make more money, when it's really the dollar amount that's going to dictate that. So in this chapter, we go over an example where we compare Caterpillar. In this example, Caterpillar is already up 100% in that current year, near all-time highs. It seemed very expensive. It seemed very overbought, as some would expect. While on the flip side, General Electric was 25% off its 52-week highs, was near support. It looked like a phenomenal deal. When we fast forward some time, Caterpillar trades 50% higher in the same period, while GE trades 75% lower after that initial 25% drop. And if we look at it today, and again, this we originally wrote this lesson back in 2018. This is more than 5 years later. The lesson is still as relevant as it was nearly half a decade ago. Caterpillar is still even 100% higher than where it was 5 years ago after that run up. And GE has gone nowhere. Now it looks as if it did. It looks like it's a $100 stock, but they split the stock, making it appear more expensive. So GE technically is still trading at basically the same price. It's trading around $12 a share pre-split, where in this lesson it was at $7. So half a decade later, Caterpillar, that was already up 100% at the time, is trading 100% higher, while GE, that was trading 20% off its current high, had fallen by 75% and is still in that very cheap, Mickey Mouse or Happy Meal price stock that we try to avoid. And hopefully the point of this lesson is just to make you focus on stocks that are top right on its daily chart. So if we look at GE, and this is going to be top right, very visually appealing, very easy to spot. If the chart is up here, this is a great sign. When it's bottom right, this is where they appear cheap. They look like these great deals, but that's very rarely the case. Right now, if we put in Caterpillar, you can see top right. This is, it's a strong stock. It's been strong. It's been strong since the day it came out. You end up you'll get bailed out more in these names that are top right than trying to hunt for the bargains when they're in the lower right-hand corner of their daily chart. So again, that's that main point. Focus on the more expensive stocks, relatively speaking. Try to avoid the stocks that are under $30 a share. Sometimes there's stocks in the 20s that can be some exceptions to the rule, but typically the higher the share price you can focus on, the tighter the risk you can find in setups where you'll have the risk reward that typically will fall in your favor. So when Caterpillar looked expensive, and we're going to zoom back to here, when it looked expensive after the 100% run up, there was real swing trading setups in here where you can buy this name and risk 1 to 5% and achieve 30, 40, 50, if you're patient enough, 100% returns, where with the cheaper names, the GEs of the world, they look like they're cheap. And this would have been the stock around this period. At this time, it looked like a great deal. And then it became an even better deal. And then it became an even better deal. And it continued to become a better deal with time as it continued to trade lower. And this is why, even if the stock is 50% off highs, it doesn't mean it cannot still fall another 50% from that price. And even when it gets to that price, it does not mean it still can't fall another 50% from that price. So that's why we really want to avoid the bargain-based hunting. We want to focus top right in a name that's bull flagging.